help everyone who is interested in progressing in their ACCA journey. And so this is our way of giving back, to just ensure that we share our final revision classes with everyone. We'll be talking about very important things that will prepare you, put you in the right frame of mind as you go for your exams. Your exams are, let's say, 10 days or 11 days time. It's actually next week, Wednesday. So not this Wednesday, but the penultimate Wednesday. So I think safe to say we've got like 10 to 11 days, right? So we're going to be sharing with you important things as you think about that. Let me also say that we are also going to be reviewing the mock exams with everyone. So we did a mock exam, and that mock exam, we will review the mock exam on Monday, which is next tomorrow. And we are going to do that 7 p.m. West African time, because I recognize we've got international people also joining us. So that will be 7 p.m. West African time. We're just going to review it, and I'm going to share the questions with you as well too. That is the question that was tested in March, June 2021. That's the question we did for the mock exam. So we're going to be reviewing it. What did the candidates do right? What should you do right in your exam? Give my thoughts on those who submitted their responses. This is what they did, what they could have done better. And if possible, in fact, I'm really thinking that we're going to solve a question on that day as well, to next tomorrow, on balance scorecard. I sort of looked at the question again, and I felt, no, let's really solve this question as a class rather than just doing a general high level review. But let's actually do that question. So it's safe to say we're going to have a continuation of this class on Monday, just next tomorrow, 7 p.m. West African time, right? So what are we going to be discussing today? What are we going to be discussing today? We're going to be discussing the following. So I'm going to give you a high level overview of the syllabus, just so you understand the relationships and the connections in this particular course. And I'm going to be telling you, based on my review from like the last 10 exams, some of the very important things to pay attention to if you want to do well in your performance management exam. And then I would then highlight the key skills you need on the exam day. So what are the success skills on exam day? So we will look at some questions. I'm hoping we can cover two, right? This will be the one we are going to look at on Monday on balance scorecard. Very wonderful question. And I deliberately chose very recent questions. I wanted to really make sure that we're looking at questions that reflect the examiner's current mode of thinking. So I make sure I restricted my questions to the last three diets. So we're going to look at a question today from December 2021, the most recent paper you're going to find on the portal. We're also going to look at a question from December 2020, which is the third most recent question. And then on Monday, we're going to look at the question from June 2021. So very recent questions, so that we're all understanding the way the examiner is now testing a lot of the questions, what to look out for. So that's what we're going to do. So we're going to do that. The emphasis on today's class is on performance measurements. But before we get into performance measurements, I'm going to show you the relationship with every aspect of the course, what you should be doing, where you should pay attention to, and how to make sure that on exam day, you walk away with at least 50 marks, right? That's the minimum we want. And simply saying that you pass on exam day. So that's the big picture. So how is the course structured? This course, performance management, how is the course structured? And I'm doing this because one, I think sometimes that people somewhat approach the paper without being too clear on how the paper relates to each other. And sometimes you might be focusing on a lot of aspects of the paper. So maybe you've been focusing on budgeting, you've been doing a lot of questions on budgeting, and then guess what? You're going to be faced with a question on performance measurement, or a question on technology, or a question on cost management, specialized cost techniques, and then you're wondering, oh, maybe I didn't get a very good hang of the course, right? So the course is structured across 6 sections. 6 sections. What are these 6 sections? Section A is titled Information, Technology, and Systems for Organizational Performance. What does it entail? I'm going to share with you very soon. Section B is titled Specialized Cost and Management Accounting Techniques. We're going to look at very specialized cost management accounting techniques. I'm going to share with you very soon. We'll look at decision-making techniques. That's what Section C covers. Section D is budgeting and control. Section E is performance measurement. And a relative new addition to the syllabus is Section F, which is employability and technology skills. And you wonder, what does that mean, right? I'm going to break it down. It simply means that part of the skill set you should have for these exams are very good, what I'll call technology appreciation skills or computer dexterity skills. So we are saying that if you are going to do well in your PM exam, aside the core technical knowledge, these first five are technical, right? In terms of they speak to what the content really is. But you've got to be able to know how to use very common technology tools and platforms. So you should be very comfortable with using spreadsheets. You should be very comfortable with using word processing documents to present your answer. How can you navigate across several computer screens? Those are the sort of things that you should be focused on in section F. And to be honest, if you can use your computer-based exam platform very well, the test-rich platform, you will be fine. So before before the class started, I put it out, I think about 1 hour ago, that please come with your mobile devices, come with your laptops, come with your desktops. We're going to be solving our questions only on the computer-based exam platform. And just to emphasize section F in action. So I'm going to make sure that I spoke on A, B, C, D, and then we're going to use F as a demonstration. So we're going to solve our question on this computer-based exam platform. Right. So what is it in section A? I like section A because I think it's very important. And I also think that this is the section of the syllabus where you can get very easy marks because we're speaking about current technologies that can support organizational performance. Now, let me be clear on something. Performance management refers to the collection, everything that needs to happen for an organization to achieve the objective. So the whole concept of ensuring that an organization can achieve the objective, what they need to do, whether they need to budget rightly, whether they need to source for relevant information, analyze the information that they have, measure the performance information that they have, understand how to do their various cost metrics and cost management techniques. Everything, the sum total of everything that an organization needs to do to achieve the objective, we define it, right, as performance management. How do we then ensure that we're managing performance in an organization? You will be leveraging on technology platforms. So if you think about most businesses, I guess even every business, how do you gather information on your sales transactions? How do you gather information on your purchase transactions? How you gather information on the right costing you're going to apply to a particular product or a service that you offer? You need all the bits of information, and you will be best off when you use technology platforms, information systems to be able to gather all this information. So it makes sense that one of the things you'll be looking at in this paper is understanding the various types of information. So one of the things I'm going to be asking you now is, do you understand the sources of information for every organization? So where can organizations source the information that they use for making decisions that will help them achieve the objectives? So you can source from information internally or you can source from information externally, right? So a good way to look at an internal source of information is through your inventory systems, through your sales transaction systems, through your internal accounting systems, right? So the point is that internal information does exist. You have them in various systems that you have within the organization. You also have external sources of information. So for example, the Finance Act is released annually. That will give you a very good indication of some of the policies in the government. So what my tax rate look like for the organization, those kind of decisions around, okay, what's the government's sort of fiscal policy? Where are the areas of the government focus for a particular year? You get that kind of information. Also, too, sometimes you might want to get competitor information. So what are my competitors doing? How much revenues did my competitor earn for the particular period? You want to do a peer-to-peer analysis. You will get that kind of information from public sources. So like the internet, right? So you can get that kind of information. Or you might get information from a very good financial source or what is quoted on the stock exchange. All those are external sources of information. You might find this question a lot in your objectives, and you will find it as part of your objective question. It's important that you understand the distinction that an internal source of information is an information that resides within the organization. Why an external source of information is an information that resides outside of the purview of the organization. So, for example, a tricky question, they might ask you that Jonathan is the sales manager of XYZ PLC. He sat down all through the morning trying to analyze information on the internet around what needs to be done to be able to meet up, the market leaders' sales performance for the month. He spent 8 hours gathering this information on his desk. And then they would ask you, what kind of information is this? Is this an internal sourced information or an external sourced information? Who's going to give me your response?
External.
All right. So what was the trick? The trick was that there was a lot of emphasis on the fact that he sat down on a system. He did nothing from morning till night. Making it feel like it's an internal information, right? But the picture is, or the big picture is, the fact that that information was sourced from outside of the organization's record. That makes it an external source of information. So you see those kind of tricky things in your exam, right? So for example, you might find another variant. They might tell you your publicly quoted your publicly audited financial statement, or your financial audited statement that has just been shared on the stock exchange. What kind of information is that? Is that an internal information or is that an external information? That kind of a thing, right? So if you source the information internally, it's internal. If you source it externally, it's external. So just to understand those distinctions. So you might see questions that might ask you things on performance management information system. So you might find things asking you, what are the types of information systems? So you at 3 levels, you would find something like what we'll call let me go with the very operational level. So you might find systems as what we call a transactional processing system, right? So for example, if you think about your sales processing in the organization, the systems you use for processing sales, those kind of systems are very transactional, right? And the information they are from transactions. So that kind of system is at one layer, but it's part of the performance management information system, but it's at the operational level. So it's the operational people who process sales transactions. So someone wants to purchase something, you're processing that kind of transaction, you are going to get a receipt at the end of the day. Those kind of systems are very operational, right? Used by operational people processing operational information. So that's one level. Then you also have what you call decision support systems, right? And this is used at the middle management. So you can call this a tactical system, right? And because in a decision support system, the idea is to make decisions, right? So it's one of the things you will find is that as you go up the ladder and as you think of information systems as we move up the ladder, there's always a distinction around what are the characteristics of the information that will be used on those systems. So transactional processing system, which I've said is used at the operational level, are mostly internal information that is being processed. So for example, you purchased something, your inventory management system is transactional in nature, right? You purchased a sales processing is transactional in nature, and it's also about internal activities. But as you get to the tactical level, and I gave an example of a tactical um, level information system as a decision support system, it can contain a mix of internal information and contain a mix of external information. So you want to make a decision. So maybe your decision will be focused on what your organization has done. So maybe, for example, what has been customer demands over the last 3 months, right? And then you might want to tie that in to information as to what have been the customer demands of your competitors, so that when you want to make a decision as to saying, okay, do we increase our capacity in producing a particular product, it will be one based on the data you have internally about how many people have purchased from you from that period, and also what's it like in terms of what your competitors have also done. So you can make a decision on saying, are we going to increase our capacity for a particular production line, or increase the volumes we are going to be making over the next 6 months based on what has happened over the last 6 months, both internally and also what has happened with our competitors. And then you can make those decisions. So my point is that another example of a performance management information system is a decision support system. At the strategic level, you have what I'll call an executive information system. So if I wanted to be sure that some people here were very clear on what I'm doing, let me show you with this sort of analogy. So this is at the strategic level at every organization. This is at the tactical level, and each of these levels require an information system. And then this is at the operational level. So I gave you an example of this as a transaction processing system. You might call it a TPS, right? Your point of sale systems, right? Your inventory management system, etc. This one, you call this one, and a good example is your decision support system. I have seen a past question once where they said MIS. That was just the word, right? So you might find something like that. It's also at this level, management information system. Because the idea is that who is at the tactical level? It's really the management. So when we say management, mid-management sometimes. So the word gets used interchangeably, right? So you might find that one of your options in your exam might be MIS, meaning management information system. That's also at the tactical level. So at this level, you have a good example is called an EIS. What does EIS mean? I just said it not too long ago, but just to be sure that everyone is with me, what does an EIS mean?
Executive Information System.
Fantastic. So what are some of the characteristics or the attributes of that kind of system at that level? So one is that the system would be reporting a lot around visuals. So charts, the ability to run charts, the ability to present a lot of pictorial analysis, right? The ability to also rely a lot on external. In fact, a major characteristics is that the information are very, very externally inclined, because at a strategic level is about the long term of the view of the organization. What really impacts the long term is what is happening outside, what is happening in the competition, what's happening in the industry. Those are the things that can impact your ability to stay in the long term. So a lot of the attributes of what you will find with systems at that level is what is
Sorry,
happening
please, what
in
did
the
you call
industry,
the EIS?
executive information system.
Okay, thank
All right, that's fine. Okay, so you will find these areas largely in your objectives. So it's important you do this. There are articles on this. If you want me to still share with you the articles on all what I've discussed, I mean technical articles, I can still share that with all of you, right? Now, another area that I'm so passionate about, and I repeat, I'm so passionate about, right, because it's what I do outside of here. It's data analytics, and it's very, very central. I dare say, and you can quote me and take me to the bank, that you will find at least one question on data analytics, right? So, what is it about data analytics? Well, the conversation is that we have a lot of data we work with, right? In fact, the whole concept of information is that information is actually processed data. And we live in a world where we are not short on data supply, because we are creating data at a very alarming rate. A very good way to think about this is, so think about the amount of transactions or the amount of activities, not even transactions, the activities that you carry out on your mobile devices, whether you're sending a message or scrolling to a WhatsApp status or updating your WhatsApp status, or you're trying to do something on social media, on the digital media platforms. And so we like to say that we are in a data revolution era, because the pace and the rates at which we are creating data is unbelievable. So think about this for a business, right? What sort of data do we now have that helps us look at our performance? So whether it's it that we're trying to introduce a product to the market and we're trying to sample customer opinion. So we go on the internet and you can find that through your social media platforms, you can start driving engagement with customers. I'm going to set a release date, a launch date for my product. And you can start driving engagement with customers at that kind of level. So you can elicit data already. people can be excited. You can get pre-order from potential customers. Even customers' reactions to a market launch, to a particular product, has taken an unbelievable dynamics now. So the way customers and potential customers can interact with a business has significantly changed. Over the last couple of years, you could interact with a business strictly by maybe having a very transactional approach with the business. So if you wanted to get something, maybe you call a business, you get a number, you call them, you get information out of them. But now, thanks to Web 2.0, and now we are speaking about Web 3.0, you have platforms that are very interactive. And when I use interactive, is that these platforms are driving two-way engagement. So for instance, you don't need now to basically have a transaction with a business for you to start exchanging information and data. You can walk up to a website, any website of any business that you've ever thought about interacting with them. Maybe go on the website and you are driving a two-way conversation, maybe by a web chat. Maybe there's a chatbot who is interacting with you on the website. How may I help you? Or you might just go on social media and tweet at a business, or go on any of the social media platforms, right? And then you start driving engagement with the business, right? So the point is that organizations now have an unbelievable, and I use the word unbelievable, if I explain the data, you understand why, an unbelievable amount of data now. And the way we look at performance now and planning for performance has taken a drastic dimension. So we're now in an era where we now say we've got big data. And the reason we say we've got big data is because we're dealing with data that is voluminous. We're dealing with data that is created almost at the speed of light, if not even faster than the speed of light. And we are looking at data that is not just in one form. So before, data could have been simple text message. So what is your name? That is the kind of data you might find in an organization: your name, your address, your phone number, your date of birth, etc. But that's not the only kind of data now. So people can go and put an emoji icon to a post. That's data. Somebody can decide to put a thumbs up on any post you are doing. That's data. In fact, you even have realms of this kind of data that you are now having different types of analytics on this data. So there are people who specialize on analyzing data on their social media platforms. We call that social analytics. So my point is that it is important that performance management candidates and students realize that data analytics is so central to the way we store, organize, and manage information and process information. You will be tested on this kind of question. So a very simple way to start is, because there are two, is like a twin, a set of Siamese twins, right? The first side to data analytics is the concept of big data. The second side to data analytics is now how you analyze that big data, which is where you have the analytics, right? And I'm sure you know that at this stage, there's what we call the V's of big data. You might find that in a question, a simple objective question. Who knows the V's of big data? Who is happy to share with me? Just let me see and be sure you know. So we've got like 5 V's of big data. Who is confident to just tell us about it? Yeah, I see a hand up. That's
Hi.
Emmanuel. Emmanuel, feel free.
Okay.
Yeah. Please go on.
Morning. There are 5
Okay,
V's data.
All right, fantastic. List them out. And this might just be an objective question. So say Jojo helped you get 2 marks on exam day. Go on.
Volume, variety,
Oh, I think.
velocity.
Okay. Say that again. Volume, variety. Go on.
Velocity.
Yeah.
Volume, variety, velocity, veracity, and value.
Fantastic. Fantastic. So because it's a revision class, we're not going to go through and rehash all this. I just want you to read up that article. You will find, I didn't say you might find, you will find a couple of questions on this part of the syllabus. And my hope is that I've elicited your interest to want to go and read those articles so that you can get some marks for yourself on exam day. All right. The next part of the syllabus, where it becomes to get very technical now, and I mean very computative, is in understanding the various specialized cost management accounting techniques. Let me share something that might excite you. You will not find this under the constructed response area. You would only find it in the objective, the MCQ questions. So whether it's the broad MCQ questions in section A or the case study related MCQ questions in section B, but you won't find it as a constructed response question. So I also think these are areas where you can do so well. Activity-based costing, understanding the concept of activity-based costing, which is essentially allocating overheads, right, on the basis of the cost drivers that drive the constituent cost you find under the overheads. So there's a land technical article on ABC, but I'm pretty sure that you all are going to be doing fine with this, right? There's also the concept of target costing. And how does this work? So with target costing, the idea is that there is a target price that is sold in the market. Because a price, or what you might call a target selling price, is essentially, the concept of a selling price is that you should know these things at this level in PM. The concept of a selling price is that it is an amount that is stated that includes both the cost of producing that product or service plus a profit margin. That's the fundamental concept of a selling price, meaning that your selling price is never always equals to your cost. It's always your cost plus a particular profit margin, right? Now, with target costing, there will be what the market would have defined as a target price, maybe a price that is sold in the market. So let's call that the target price we're trying to achieve. Now, for us to achieve internally that price, that target price, we must work out a cost that then allows us some bits of margin we can then apply on that cost or markup, if you want to use that term, to arrive at that target price. So the target cost usually is our focus in target costing. Because most often than normal, you might find that that target cost that you're trying to achieve so that you can get the target price might be at variance with your own internal cost of production. And then you're going to have a scenario, and that scenario, we call that a cost gap. So let's say, based on what the target selling price in the market is. So let's say you have something like the target selling price in the market is 150. The company might usually say that their profit margin is usually 20% on the selling price. So what is 20% on 150? That will give us 30. So that means that our target cost will be 120. Now, most often than normal in the exam, your production cost might be something like 125. Or I'm not saying a particular amount, but I'm just saying there will be a variance. So you now have what you call a cost gap. So one of the things you will be doing in your exam would then be to suggest how you then close out this cost gap. And a lot of the times that suggestion can flow with rethinking what are some of the costs that you incur in your production cost and how you can essentially work on inefficiencies if it's what's leading to that cost, or somehow bring down that cost, maybe by rethinking, maybe some bit of research, redesign, just to ensure that you can bring down that cost to meet the target cost that you've worked out. Throughput cost, throughput accounting, life cycle costing, environmental accounting. I think you should pay particular attention to environmental accounting as well, and I'll tell you why. So this is me using this last class to predict my thoughts. Why I say you should think about this is that SCCA has what they call theme. So at every quarter and period, we have a theme that drives, because we are a social enterprise, right? For good, we're not for profit. So we are always driven, our actions are driven by certain cardinal points for us. So one of the theme for ACCA for this period is sustainability. So we have a lot of articles we've released on sustainability. For those who are ACCA members, there's been a lot of CPD programs, training programs. ACCA even has a certification course now on sustainability for finance professionals. So some of you here, if you're interested in that kind of a thing to just improve your understanding of sustainability, you can go for that course. It's sold at £200. But my point is that a strong element in sustainability is environmental issues. And so environmental accounting is a very, very popular area now that the examiner is paying attention to and likes to test. So your various ways to look at environmental management accounting, you would have covered it: flow accounting or flow cost accounting, input output analysis. Let me even just throw this up because I'm not the one who's supposed to be teaching as at this point. I mean, is you. You're all going to be writing this exam next week, Wednesday. So I should be hearing from you. Can anybody here tell me the various mechanisms in environmental accounting? The various ways you can account for environmental cost? Accounting for your environmental cost. That's essentially what we are speaking to. There are 3 to 4 popular methods. Who is happy to tell me? I listed out some not too long ago. So I think I have to keep minimizing my screen to see who is speaking. So I think I've got a hand. Nobody? Who is going to share with us? There must be somebody who is happy to share with us now. Try. It might come out on exam day. And yeah, so Esther wants to speak. So Esther, let's have you speak to us.
Flow charts. Then we have inflow and outflow.
Did you say flow charts? Did you say flow chart? I want to believe I didn't hear flow chart. So.
Flow cost,
But just go on. Say the ones you know.
input and output analysis.
Oh dear. Am I the only one?
Life
I
cycle
feel like she's
costing.
breaking up. Yeah.
Life cycle costing. Input
Yeah.
and output analysis. Flow cost
Fantastic.
and accounting. Activity
Yeah. Yes.
costing.
So you have environmental-based, activity-based costing. You have your flow cost accounting, looking at your material flows. How many came in? How many materials came in? How many materials have been transformed into output? You have your life cycle costing. It's important to understand, and that's why life cycle costing is very important. Life cycle costing is an attempt to understand the cost of a particular product or service by looking at all the various costs associated with that particular product or service all through its life cycle. So there's a terminology I always use when I teach this. I call this from cradle to grave. So, and a simple way to look at this is that when we speak about product costing, sometimes we tend to look at it around the likes of what is the material cost, what are the associated labor costs, what are the associated overheads. But there are some other costs that we don't look at because we don't take a full life cycle view. One is research and development. A lot of times before a product or a service is being launched by an organization, some element of research and development might have been incurred in that product. So some products are very innovative. So if you think about how most of the products from many of these tech organizations like Apple, many of the Apple devices you will find, Samsung, many of all these tech gadgets you see, a lot of cost went into research. Someone has to be. Are you guys failing this test of knowing you have to be on mute? Paul, please stay on mute. Don't be found before we hear what we shouldn't hear. All right. So that's fine. That's fine. So some costs, like I said, are normally neglected when we look at typical costing for products or services. So I gave you an example of research and development cost. That a lot of innovative products, we forget that a huge amount of what went into producing that product was actually the amount spent on doing the research, the design, the innovation around it. So when you look at life cycle costing, you start looking at it from even the conceptualization stage of those products. Were there research costs associated with it? Were there some developmental costs? You look at all that cost. Sometimes too, at the end of life of those products, meaning when you are trying to now send those products into extinction, decommission the production of that cost. And you will find this sometimes with production plants. So for example, those oil companies that do a lot of excavation, that do a lot of exploration, mining of oils and minerals, they would usually carry out those activities at a particular site. After they've produced those ores or those minerals, right, or those mines, right, what will then happen is that they have to restore back those sites to the original state of those particular sites before they started doing those exploration. We call some of that examples of those costs decommissioning cost. Akin to with products, the same with products. Sometimes to a product, by the time the product have gotten to its end of life and you want to decommission the sales of that product or the production of that product, there are some associated costs with decommissioning those products. You might, so maybe there's some special equipment for that product. You might need to some cost in getting off those equipment, disposing of those equipment. So when you look at your life cycle, essentially is that some costs are omitted when we account for products that are actually will be seen if you take a full life cycle view of the product. I'm saying this and spending time so you understand the concept in case you find it as a theoretical question in your exam. I mean, like an MCQ. But please, there are articles for all of this. There are articles on environmental accounting, articles on target costing. So refer to the technical articles on the ACCA page. But if you want me to share them with you, I'm happy to do that.
Hello, sorry. Before you move on, good morning.
Yeah, good morning.
So I think the thing about this cost techniques is that not like I don't understand the reading aspect, but especially when it comes to this activity-based costing and target costing and throughput accounting, how to like when I see the question, how to go about it. I don't know if you understand what I'm saying. It's not like I don't know
Yeah,
the
so
formula or what to
basically
do,
your
but
point is
sometimes
how to solve those
yeah, how to
questions, right?
like put the questions into years into solving this and so. But I guess the more I practice, I'll discover other
Yeah,
ways.
yeah,
But I
yeah.
guess that's the only issue.
And yeah, and I don't know if you are actually our students because we have some external people. I would have said you can reference the videos. You know,
Yes, I
we
am.
put out all our, yeah. So all our videos, just check your WhatsApp group for links to all the videos. And our videos are done in such a way that we label the course we covered on that day. So what I'll just say to you is that go back and look at the video on the day we taught ABC or throughput accounting, and if you've got questions, then we can then take it up from there, right? But just
Please,
go back and
some
watch the video.
clarification on this environmental accounting. The likes of this hidden cost, abnormal loss, normal loss, conventional.
Yeah,
Can
yeah,
you please share
yeah.
more light on that, please?
Okay, so to be honest with you, I'm actually pressed for time because I want to also cover. This is section B, and we have up to 6 sections, and there are quite a lot of things. And I just want to do something, right? I'm happy to take it like offline in terms of maybe on our WhatsApp group, etc. But I also want to manage time. But the point is that when you take a life cycle view, or maybe I think you spoke about environmental accounting, there are about 4 different methods for accounting for. So the point is, with environmental accounting, you're trying to account for environmental cost. That's essentially what environmental accounting means. How to account for environmental related cost, right? And a lot of the times, right, some of those costs, when we say hidden cost, right, the point is that if you look at the way we cost products, we cost product essentially, if you think about it, and that's why we have a lot of all these techniques. We cost products in broadly 3 ways, right? So if you wanted to assign a cost of a particular product, there are broadly 3 types of cost: the material cost, the raw material cost for those products, the associated labor cost for those products, and then the overhead cost. So now the point is that for many organizations, environmental related cost, maybe the cost of decommissioning, the cost of clearing up a site when you've done a lot of harmful activities to the environment. Maybe the cost of even preparing a site for some kind of exploration that might lead to some sort of environmental impact. So the point is that many of the environmental related costs are usually lumped up and hidden under overheads. So there's a temptation to not properly, because the concept of overheads is that every particular product in an organization will get a share of overheads. I hope you know that much. With material cost or with labor cost, you can directly assign them to a particular product. So you can say, okay, how much material cost for product A, how much material cost for product B, how much labor cost went into product A, how much labor cost went into product B. But when you get into overheads, it's usually an apportionment you do, meaning that every single product in the organization, they would apportion the overheads of the business, right, to each of those products. So the point is that many of the environmental costs are usually lumped up. In fact, our accounting systems don't even make it easy for us to even do proper accounting and classification of environmental related costs. So it might be, right, that a lot of environmental costs are hidden, and that's where the hidden comes in, are hidden under overheads. And when they are hidden under overhead, it has two impacts for the organization. One impact is that the organization will lose visibility of how much environmental impact that they are actually responsible for. The second part is that we might not be able to properly apportion, or not able to properly, you might not fairly apportion the right amount of environmental cost because they are lumped up under overheads to the particular product that was responsible for the generation of that cost. But I just want to beg you for something. I don't want to do detailed explanation on any of these concepts. I just want to spread out and tell you key issues, and then we'll go to the business of today. So I'm able to solve a question today. I don't know if that helps, or you still want me to speak a bit more. Just tell me, and I'm happy to do any of the two for you.
Okay, I think we can always take it maybe after the class or maybe on WhatsApp, so we can
Yeah.
focus on the for
Yeah,
today.
please. We've got a lot. We've got a lot to cover today, please. All right. Decision making. In fact, maybe I'm the one even spending time. Maybe I'll just be running through now. Decision making techniques, very important. So you will find that from this area, decision making techniques, budgeting and control, performance measurements, they can be tested across section A, section B, and section C of the syllabus. So some of the things, understand what a relevant cost is. Is somebody here happy to unmute and tell me what a relevant cost is? Do you understand the concept of a relevant cost? Understand the cost volume profit relationship and analysis, very important, CVP. Your limiting factors, you will find that for some kind of, and that's where we talk about making decisions. So sometimes your ability to make a decision on something would require that you understand if there are factors that can be limiting to making that are responsible for why you'll be making the kind of decisions you will be making, right? So you know what the limiting factor is, and that can stretch sometimes to situations where you might have more than one limiting factors. Then you might be required to do things like linear programming to solve that kind of situation, right? Pricing decisions are very important. Make or buy, and a lot of other short-term decisions you'll find. So lease back, should you make, should you buy, should you go on lease, those kind of decisions, and then dealing with risk and uncertainty as well too. So I hope you are all comfortable with those formulas, right? I won't say formulas, but understanding how to make decisions based on your risk appetite. Also, for example, how do you make decisions using the maximax approach? How do you make decisions using the maximing approach? How do you make decision using the minimax regret rule? And then how do you even make decisions using the expected values? So at this point, I want to hear an audio response. I want to get an audio response. Is this something that you are comfortable with? Maximax, maximin, minimax, regret rule, expected values. I want to ask everyone.
To an extent, to a great extent, yes.
All right.
Yeah, same.
Part of why I'm doing what I'm doing now is to show you the way the course is related, right? So be comfortable with these areas. Be very comfortable with these areas because they can show up across every section of the syllabus. Now, this is where it begins to get very thick now. Budgeting. And let me add that part of the reasons why you must get it right with all these concepts and all these topics we are covering is that this paper and a lot of the papers at this level builds up to the choices you will make when you get to the strategic professional stage. So if you find that you are very comfortable with PM and you understood all these concepts, we are going to build on it when you come to APM. We're going to build on it when you come to AFM, if you are comfortable with FM. We're going to build on it when you get to ATX, if you are comfortable with tax. We're going to build on it when you come to AAA, if you are comfortable with AA, which is audit and assurance. So part of the reasons why you must be comfortable with these areas is that it can influence your choice of what optional papers you'll be covering. All right, section D of the syllabus looks at budgeting. The quantitative side to budgeting, obviously, you might be asked to prepare some budgets. Yeah. Also, theoretical questions can arise in budgeting. Someone might ask you, what are the various approaches to budgeting? What are the various types of budgets? In fact, I'm tempted to ask somebody to answer because I'm looking at MCQ questions. And let me warn, and I use my word carefully and advisedly. Let me warn that this paper is not a purely calculative paper. I must say this, and I want to be very clear. PM is not a purely or is not a wholly calculative paper. In fact, I'm going to show you with questions today that I find that you have more more theory than calculation in PM. I don't know if somebody heard me clearly. I find that there are more calculations. Why am I making this mistake again? Who can help me say what I'm trying to say?
You're trying to say that
Can
there are
someone
more
help?
More
theory
theories than
than
calculations.
calculations.
Yeah. There are more theories than calculation in PM. Let that be like something you took away from this class. There are more theories than calculations. There are more theories than calculations. There are more theories than calculation. So what am I trying to say? Understand the rationale, understand what you're doing more than what the calculation is about. And that's what makes ACCA very distinct. It gets even worse when you get to the strategic professional stage. It begins to look something like 30-70. 30 for calculation, 70 for analysis. You must be able to understand the numbers. So you might find questions asking you types of budgets, why this particular budget is suited for an organization, etc. Obviously, there'll be the quantitative side as well too. You will do some quantitative analysis, standard costing, very, very important aspect of this course. Understanding the concept of what a standard cost is, because it is important from a performance management and measurement perspective that we look at efficiencies and inefficiencies by understanding what truly should be the standard cost of a particular product and compare it with the actual cost. And in fact, that's where the concept of a variance comes in. A variance shows you the variation. The word variance comes from variation. Shows you the variation between what a standard cost is and what the actual cost is. Businesses try to promote efficiencies by coming up and having a template where they understand a standard cost of a particular product or their processes if it's involved in generating a service. We know that that cost might differ from the actual cost. So you use it to promote efficiency by saying, look, you are not performing well as a business if your actual cost is exceeding the standard cost. And from a performance management perspective, what is even important for this paper a lot is where there are variances. Can you explain why the variances? In fact, more importantly is you have to understand why the variance did arise in the first place. So for example, why do you have a material mix adverse variance? Why do you have a material yield adverse variance? Or why was there even a material mix favorable variance? Why was there a sales mix favorable variance or a sales mix adverse variance? That is where lies the opportunity to develop and improve performance. When you can understand the reason why there are those variances, why there are those variations, positive or negative. In fact, in the real life or in real work, in the workplace, where there are favorable variance, you try to understand why, so that especially when you are doing this analysis or this variance analysis per SBUs. SBUs is a term we use in business for strategic business units, each autonomous unit. When you want to understand how a part of a business is doing, why they are performing better, and you can use that to spur and encourage the other parts of the business. Oh, look, Division A has very good variances. Division A, can you share with the rest of the business why your variances are so good? And then you can use that to improve performance, right? So I just wanted to say that. Now, there is what we call planning variance and operational variance. And I'm going to just give a very high level. I don't want to go deep into these things because one is I'll be unfair to what we are supposed to do today. I really want to give a high level, but I'm speaking to an exam perspective, what you should know. Even if you understand the theoretical explanation I'm giving to you, it will just be a matter of application when you see an exam question. What are planning variances? What are operational variances? Is there somebody who can just try? I just want a high level understanding of this. What are planning variances? What are operational variances? Who is happy to speak? Just 1 minute.
Okay, I think
Okay, so
planning
planning,
variances are variances
Okay,
that
no, I think
occur.
Simi started, so let's Simi continue. Go on.
Okay, so planning variances are variances, differences between what we have planned and what we should have planned. While
Hmm.
operational variances is there are differences between um what we should have planned and the actual, like the actual results.
Okay. Um, well done. But let me just
Just
use
to
a
add to that,
sim. Okay, go on, go on, go on. Somebody wants
okay,
to add. Go on.
yes, I would say planning variances are those, it happens because the manager does not have controllability over it, whereas operational, he has total control and can be faulted when it's adverse.
Okay, I like what you've done, but I'll give you a simple way to understand it. Both of you, well done, Faith and Simi. But let me give everyone in the class a very high level way to look at it that will make sense. So usually, right, the concept of a variance is always around what you budgeted for or what ideally you expect, right? Vis-a-vis what the actual will be. So essentially, what you will find is that you might find this kind of scenario, and I'm going to give you 3 scenarios. So you might have what I will call a budgeted amount or budgeted figures. Along the lines, for whatever reason, right? You might then need to make a revision to the budgeted amount. So I'll call this a revised budget or a revised budgeted amount, right? And then obviously you have the actual. So these are 3 scenarios. Now, the variation between the budgeted amount and the revised budgeted is what you have as your planning variance. While the difference between the revision and the actual is what you have as your operational variance. So I'm going to now break it down again to explain to you. The reason why you might make a revision on what you initially budgeted to, we like to say that it is because there were inaccuracies in your planning. So those who are held responsible for a revision to an initial budgeted amount are usually the strategic guys in the organization. Now, when you then have this revised amount, the difference between that and the actual is the operational variance. And we like to say that the reason you have an operational variance is because the operational guys then didn't ensure that what your new revised budget was actually became the actual. So that's where you find that you hold the operational managers responsible for that. So planning errors are what leads to planning variance, while operational issues are what leads to an operational variance. You know, in an ideal situation, it should be budgeted to actual, but where you might have a revision to the budget, we say that's because of planning issues. And so it's the strategic guys, the management guys, are the ones responsible for a planning variance. While it's the operational guys that are responsible for why then this now revised budget isn't the same we have as our actual. Does this make sense now to understand the difference between planning variance and operational variance?
Yes. So which one is market size and market share variance? Because I think I've seen it in some questions.
But that's not like related to what we're doing. So let me give you a trick for your exam. The lady who asked, and sometimes I see this in revision. People are now saying, I think I've made this question before. Let me shatter everything here. But let me tell you something. For me, and I'm telling you what can help you pass, shall know that a variance arises when what was intended differs from what actually happens. Whatever you call it, market variance, market size variance, the organization's estimation of the market size and the actual market size, where there's a difference, then that is what you will call a market size variance. The organization's understanding of the market share and what the actual market share is, that difference is the market share variance. Just understand it as that concept, and then it becomes easy to say a question. And once you understand, that's why the concept is what gives you the marks. If you understand
So,
that, whatever.
okay.
Okay, somebody wants to speak. Go on, go on, go on, go on.
No, no. I was going to ask how about the sales mix and sales yield. Or is it sales quantity?
But
It's different.
that's why I'm explaining. That's why I'm explaining all this to you. That funda and if you look at the way I have it on my slide, planning and operational comes after you've covered sales mix. At this level, from sales mix, quantity variances, it's the difference between the standard cost versus the actual cost. Where you now move into these new ones I'm speaking on is when we now get into planning and operational. That's where I begin to explain this. So for those material mix, for those material yield, check the questions. And if you have a question, you can put it out on our WhatsApp group. There will be a standard amount. There will be a standard amount that would have been stated, and then you work out the actual, and then you can see whether it's adverse or whether it is favorable. Is that clear?
Yes.
Okay. Now, the focus of my class today will be on performance measurements. And I'm going to tell you why I want to focus on performance measurement today. It's one of the most poorly performed performance areas. I mean, it's an area where candidates perform poorly the most. Diet in, diet out. Let me also give you another statistics. Performance measurement is 40% of the syllabus. You cannot pass this exam if you are not comfortable with performance measurement. This is at the heart of performance management. So, what are the topics involved? Performance analysis in the private sector, useful model that comes to my mind, I just want you to put out here the balance scorecard. The building block. Also, simple analysis around financial, you would see some questions like that. Carry out a financial and a non-financial analysis. Another part of this course is divisional performance measurements. So what are the various divisional performance measures? Are you comfortable with computing ROI? I know that last week Fola did a brilliant job with you guys. You guys solved a lot of MCQs. Are you comfortable with residual income? But like I will remind all of you, I hope you know the advantages and the disadvantages of both. So I want to ask, do you know the advantages and the disadvantages of these metrics? Just a simple yes or no. I just want to hear that from you.
Yes, sir. Yes.
Okay, so someone has said
Yes.
yes on behalf of the class.
Yes, but you can add to it.
Someone is saying no as well.
No,
Yes, but you can
No,
add
I
to
no,
beg.
it.
no, no.
You guys, we're not going to have a detailed class today if we got if we continue like this. Okay, but I'm deliberate when I'm asking you, do you know? I'm forcing you to think. That's actually what I'm doing. So let me expose myself. So that's what I've been trying to do. So when I ask you those questions, I'm actually trying to force you to be sure whether you understand what I mean. But what I'll tell you is use this simple trick for your exam. An advantage of one, because most time the advantage is always a relative advantage, meaning because the both of them are types of divisional performance measure, but they fundamentally differ in the application. So take for instance, return on investment. What is return on investment? Divisional operating profits over the investment in the division. Some might represent that as the capital employed in the division, whatever. But this is how to look at it. Now, you see that ROI is a relative measure. It is the relationship between the divisional operating profits and the investment in the division. So most times we express it as a percentage. So you might say, the ROI of my division is 20%. So let's say the divisional profit is $200,000. The investment in the division or the capital employed in the division is $1 million. So 200,000 over 1 million will give you 20%. You say your ROI is 20% or 0.2. It is a relative metric. Now, what that means is, and I'll tell you where the advantages are, is that because it is a relative metric where you are looking at the relationship between the numerator and the denominator, in this case, the numerator meaning the division operating profits, the denominator meaning the investment in the division, it means that you can use it, and this is an advantage. You can use it to facilitate comparisons between different divisions, irrespective of the sizes of those divisions. And let me tell you what I mean so that I'm not being abstract. Let's say division A has an investment of $1 million. Division B has an investment of $100,000. Both two divisions made okay, no, let me not say made the same profit. Division A has a profit of 200,000. Division B has a profit of 60,000. All right. Profit wise, Division A had $200,000. Profit wise, Division B made a profit of $60,000. So on its surface, Division A made more profit than Division B. Is that not correct, class?
Yes.
It is.
Yes.
But when you want to understand how well they fared and saying, look, what is the relationship of this profit vis-a-vis how much was invested in your division? You then begin to get a clear picture. 200,000 over 1 million will give you what? 20%. 60,000 over 100,000 will give you what? 60%. In that case, which of the two divisions has performed well between A and B?
Division B.
B.
Do you understand it? So that's why we say that an advantage of return on investment is that it is a relative metric that shows the relationship between the profits and the investment. And so we can use it to better compare how divisions are performing. So actually, you can say division B, you had 100,000 in investment and you generated 60,000 in profit. So you can say that your ROI is 60%. So that is a good one of the advantages of that metric. So it helps with facilitating comparisons. Someone can say it is also very easy to understand. Now let's go to residual income. The first thing I will say about residual income is that, and I want to believe that you all know how to compute residual income, but let me just try to let me try to clean this up. Let me do residual income. Residual income is computed as your divisional operating profit minus what you call an imputed charge. That imputed charge is usually your cost of capital multiplied by the investment in the division. So let me just give you hypothetical values, right? So let's say the divisional profit was 200,000, division A, and then there's a 10% cost of capital. The cost of capital of the divisions is 10%. And then the investment in the division was 1 million, right? So what do we have as our residual income? Who can quickly give us answer?
Hundred
Hundred
thousand.
thousand.
All right. So notice the difference between this and when we did return on investment. Residual income gives us what you call an absolute value. Return on investment gives you a relative value. Residual income gives you an absolute value. Now, it is an absolute value because there is no relationship we are testing for here. You just have 100,000. What does that mean? If I did the same thing for division B, where the divisional profit was 60,000, if I apply the cost of capital of 10% on the investment in the division, which is 100,000, you are going to have 60,000 minus 10,000, and it will give you 50,000. So what does that mean? Do you say that division A, because they have a higher residual income than division B, means that division A has performed well? No. So that in itself highlights a limitation, that it's an absolute value and we cannot use it to drive comparisons. We can't compare. What does that mean? 100,000, 50,000, those are just two standalone values. What does that mean? Now, another important thing about residual income is that in getting a residual income, you always apply the cost of capital on the investment in the division, which is what you have here. So what does this cost of capital essentially mean? I'm going to take, for some of you who have done FM, you might relate with this. When we say cost of capital, it refers to the cost of your financing. So any capital that you are utilizing in your division or in your business, it is not for free. There is a cost you are going to pay to the providers of that capital. So essentially, a cost of capital refers to the risk associated with the usage of the capital. Let me give you a simple way to appreciate cost of capital. And this is a PM class, but let me help you. If your organization is a high risk organization, you are considered a high risk organization, capital providers will want you to compensate them if they are going to be giving you money by paying a high rate. If your organization is a low risk business, capital providers will demand a compensable rate, which will be a low rate. A simple way I always use is if you think about Dangote. Dangote can almost access funds almost next to nothing. In fact, a lot of the times when he tries to raise funding from the Nigerian banking systems, he's always oversubscribed. I mean, he always gets more funding than he always needs. So many a times after I've participated in some of these transactions, they will now have to return back the excess funds they generated. Maybe he needed about, let's say, $2 billion. He might generate more than $3 billion and have to then pay back. That also speaks to cost of capital. He would then have to refund back the extra 1 billion again back to the economy because money is not free. There's all those funds he generated. He obviously has a cost that's going to pay. But the point is that for that kind of a business, the cost of getting those funds is cheaper. So technically, what am I trying to say? That your cost of capital reflects the risk associated with financing your business. So one of the advantages of using residual income is that it allows us factor in your financial risk in looking at your performance. I hope this helps. Why is the class quiet? I said, I hope this helps, and everybody just went blank. Nobody answered me again.
Yes, sir. Yes, sir.
Yes,
Yes,
yes.
sir. Yes, sir.
Right.
We are
Another
internalizing
important
it.
another important area of this particular part of the syllabus is transfer pricing. This is an area that candidates consistently perform poorly. But I know that everybody in this class is going to do well if that comes out in your exam. All of you are going to do well. I thought someone is going to say yes, we're all going to do well.
Yes, sir.
Amen.
Amen. Let me say amen.
I'm not praying.
Yes,
Nigerians
I'm
like
going to
prayer. I'm
do
not
well.
praying. Uh-huh.
Jesus
Okay,
take us.
so transfer pricing is another area. And I know you guys did it very well last week and it was covered in your class. But let me tell you a useful place to start with transfer pricing. The first place to start is, what is a transfer price? It can come up as a 2-mark question. What is a transfer price? It can come up. The price at which two divisions trade. What are the various approaches to how we set a transfer price? And then your question they might ask you to work out the transfer price or to work out a range of transfer price. I'm not going to go and explain it. I can't explain it, but I just think you've done a brilliant job on it. And I know I speak the mind of the rest of the class that you are very comfortable with transfer pricing. Isn't that so?
Yes.
Yes, sir.
Yeah, I know that you're all very comfortable with this area. Now, let me tell you an area that I'm hoping we can touch a question if we agree on it today is on performance measurements in a not-for-profit organization. This is one of the most poorly tested, no, I won't say tested, most poorly performed areas by students. I've been teaching this course for 10 years. An area that is always woeful when students are tested in performance measurements in this exam is when they are testing your not-for-profit and public sector. But what are the key issues in the not-for-profit and in the public sector? I'm going to highlight 3 key issues for us. The first is that in this sort of organizations, they don't have a profit motive. So because they don't have a profit motive, you find out that there can be so many, and that's really the big problem. Where an organization doesn't have a profit motive, how then do you know what is so important to the organization? Because for a lot of organizations, if you ask, what is the goal of most organizations? You're here to maximize shareholders' wealth, meaning to maximize shareholders' profits in the immediate and in the long term. That's what wealth means. Profit in the immediate and in the long term. But when you go to an organization like a public sector organization or a not-for-profit, where their objective is not even profit making, and then you then wonder, okay, so what is the core objective here? It can vary. Take, for instance, the public sector. And depending on what aspect of the public sector, so let's say the judiciary or the police, to ensure that there's no breakdown of law and order. Let me use the police. I like to use the police, interestingly. So let me continue the police. So if I asked you what the objective of the police service organization or the police force, depending on what's called, some might say that the main objective of the police force is to ensure that there's law and order in the day. It's also fair to say that the main objective of setting up the police force is also to ensure that they prevent crime. Is also to ensure that they prosecute criminal offenders. Also, that they assist in gathering intelligence. My point is that one of the problems with not-for-profit organizations is that you can have several objectives. And the bigger problem with that is that which objective is the most important? Take, for instance, if the police force has largely ensured that there's peace and order all through the year, and on the last day of the year, a crime breaks out, leading to the loss of lives in a particular neighborhood, has the police done well? That 364 days, there was general peace and order. On the 365th day of the 365 days in a year, there was a massive sporadic shooting and crime that happened. That's the issue you have with these sort of organizations, that there are lots of objectives, and sometimes you can't even tell which is the most overriding one. Because when you have multiple objectives, it becomes difficult to know where you prioritize. That's a major problem with not-for-profit organizations. They have lots of objectives. Take, for instance, the public library. A library is set up to promote knowledge. So what's important? Is it in the amount of people that gather this knowledge? Some might say it's in the number of people that actually utilize the library. That's what is important for me. Some might say, look, if I have only 10 people come to the library and they get 1 or 2 points, I'm fine. Some might say, no, the library has to be well optimal. The more we have number of people coming to read, that's the problem with this sort of organizations. So many objectives that no one can seem to be more important than the other one. And it makes performance measurement very difficult in this sort of organizations. So, what is a useful approach to measuring performance in this sort of organization? So, one of the ways you will tackle this in your exam is to say, I will take every objective and ensure that I'm able to generate a metric that helps me to tell if we are meeting on this objective. So if there are 5 objectives, you underline the 5 objectives. And then ensure that you are measuring your performance across all 5 objectives. That's a very brilliant way to approach this part of the syllabus in your exam. Specifically, and you will find this a lot with public sector, but basically both not-for-profit, because you can essentially have not-for-profit organizations that are not public sector. And a good example can be charities. Some charities are privately owned. Environmental pressure groups, Even the football association, so many of you might like FIFA, might like UEFA. All of them are not for profit, but they are not public sector organizations because they are not owned by the government. The same way now we are seeing a rise even in public sector organizations, but public sector organizations that are set up for profit. So there is a formula called the value for money that looks at the 3 E's. And what are the 3 E's? Who is happy to tell me?
Efficiency,
Efficiency,
economy, and
effectiveness, and
effectiveness.
economy.
Economy efficiency.
All right. Now I want to give you a simple tip for your exam. Make sure 2 things. One, you can explain what each of these 3 means. More importantly is, can you then generate a metric that will be testing for efficiency? Can you generate a metric that will be testing for effectiveness? Can you generate a metric that will be testing for economy? And that's where the trick is in the exam. What is all the somebody just forgot about the facts is not muted, right? All right. What is economy? What is economy?
Economy is getting the value at a cheaper cost, but not compromising
Okay.
quality.
Fantastic, fantastic, fantastic. So economy is about getting your inputs. In fact, all the 3 of them, I'm going to use the word input output to explain them. Economy is about getting input. Somebody might wonder, what does input? Let me give you just a terminology. Input means resources. Your fiscal resources, your material resource, your financial resource, your human resource, all that sort of resource. Getting your inputs for these businesses at a cheaper cost, but at a good quality. So think of it that you are economic if you get cheap resources that are qualitative. You know, if you get a retired CEO of a major institution, maybe a major financial institution, a major public sector institution, you get a retired CEO and say, let the CEO come and be a lecturer in your school. That is very, very qualitative. And I can tell you that the disparity in pay with what they've been used to and what they might get will be so huge that you say you've gotten them at a cheaper cost. But the point is that many of you make economic decisions. I can argue and say, your decision to attend Ivy League is an economic one because you are getting very good quality education and they are paying almost next to nothing. If you get the analogy, I mean. So I don't want you to confuse economy as something that is cheap. Let's be clear on that. Economy is when you get something that is qualitative but at a cheap cost. So if in your exam you're asked to generate an economic metric, so make sure you're looking out for things like that. Just look at the inputs, the resources, and be able to test. So for example, a very good economic metric might be cost per. So if it's about a university and you are asked to test if they're economic, something you might do as an economic metric in that scenario would be cost per lecturer. If it's a public hospital, cost per medical doctors or cost per medical personnel. And then you can use that essentially to test.
Hi, Jojo, are you still speaking? I can't hear you.
So I said we can use that to test. Okay. What is effectiveness? Effectiveness is a measure of your output. So meaning that, what are outputs in a business, right? So the way it normally works is that every business has an objective. And sometimes for these objectives, you had a target you wanted to achieve with those objectives. So let's say, and I'm speaking from the context of public sector and not for profit. So let's say we're looking at a charity organization. Maybe they are into wildlife conservation. Maybe one of the objectives of this charity organization is to be able to conserve wildlife, meaning that there might be endangered species. So maybe you've got endangered species like what are some of these wildlife animals? So let's say the zebras. Um, um, Give me examples of wildlife animals that can be endangered if they are brought out of their space.
Lion.
Exactly. So
White rhinos.
brilliant. So let's say you have those sort of animals, and this charity is set up to because there are quite a lot of charities that do that to protect their habitats. Because the rave for industrialization, we are now encroaching into some habitats of some species. In fact, there's a concept, I don't want to take us there, but I just want to improve the knowledge in the class. There's a concept that, we as humans don't even have more rights than even lower animals, like, these wildlife animals. So there are people who are environmental activists who are setting up foundations, setting up charities, setting up pressure groups to say, look, let's not encroach into this habitat. The same thing is happening too with the sea, the oceans, aquatic habitats. Let's not go and encroach into the oceans and reclaim lands from these oceans because it is a natural habitat for some for some natural species like birds. I say like birds, like fishes, whales, etc. There's all that kind of conversation, but I just wanted to bring it here. So my point is that if a charity is set up like that, and part of the objective is to see how, as much as possible, they can bring back endangered species that have been taken away from their natural habitat back to their natural habitat, which is the wildlife. That might be the objective. So you might then be asked to use the value for money to then assess their performance. So from an effectiveness perspective is to say, what is the target that was set? So maybe the target is to do 90% or 100%. So you will see data that will tell you how many wildlife animals have returned back to their natural habitats. Then your metric for assessing that will then be to say, okay, how many animals are out there that have returned back? What was the target set? And then you compare. That is an effectiveness metric. You can use it for any scenario. So effectiveness test how the organization is achieving the objective along the lines of the targets that they set. If it's a police force we are looking at, so maybe they might say they want to prosecute 80% of the criminals that they catch and make sure that they prosecute the cases in court. You will get that data that tells you number of criminals, number of prosecution. You will now do the computation, X amount over X amount, compared with the target that was set. So if the target was 80%, compare 80% of what you should get vis-a-vis the actual amount you have gotten, and then you can now say, okay, you met the target or not. Effectiveness is about the objective vis-a-vis the target set. And it's important you understand it's about the objective vis-a-vis the target, because sometimes an organization might not do so well if you take it holistically, meaning if you discard the targets that are set. And sometimes it can be very vague. So I use the example of return back wild animals have been displaced from their natural habitat, it might be so vague to look at it as an objective to achieve. But if there's a target set, 80%, 60%, 70%, then it helps you to then understand how well they've performed. So effectiveness is an output-driven test you are doing. It's about the objective. It's about what the organization has set out to do vis-a-vis the target they've set out to do, and then you're comparing to test if they've done that. Then the other one is efficiency. Efficiency looks at the relationship between input output, right? And what I mean is, how are you optimizing your resources? A simple way to look at efficiency is to say, and I'll use the case of a hospital. If a medical personnel should attend to 10 patients per hour, and you have a situation where the medical personnel is attending to 13 patients per hour, they have exceeded what is ideally what they should be attending to. And then you can say that you are getting more out of what you are putting in. So efficiency is about optimization of the resources. That's why we say it's an input-output test. What is the output for every input? For as long as the output exceeds what we usually expect from every input, then you are efficient. So I'm going to go back again and wrap it up for you so you understand the three. Economy is about the inputs, ensuring that the inputs are of good quality and of a lower cost. Effectiveness is about the output, which is really the objective of the organization, how well the organization has fared in the objective vis-a-vis the targets that they set for themselves. Efficiency is about how we're optimizing the resources to get the output we want. Are our resources doing much more than we expect them to do? That's the three E's at play. It's a very important thing. I'm hoping if we have the time that we can look at it. And then finally, an area that I've seen a lot in objective test questions, and you just find people losing out 2 to 4 marks to 6 marks on these areas. External considerations and behavioral issues in performance measurements. And I'm just going to tell you what they
Sorry,
are.
excuse me, sir.
Yes.
Okay, just to take you back a little bit on that efficiency and effectiveness. So what you're saying now is effectiveness is getting the expected results, while efficiency is getting the most of the input.
Yeah. Yeah. Don't you hear when they always tell you that you first of all have to be effective before you can even become efficient. So yes, you are correct. That was the brilliant way you described it.
Okay, I've always been taking it like that's fine, but it's fine. Thank you, sir.
Oh. Yeah. All right. Let us go to the final one, external consideration. And I'm just going to allow you to answer these questions. This last one, I'm just going to allow you to do it because it's a very simple one. Let me give you the background. Then you see that you can all start generating the answers for me now. When we say external considerations and behavioral aspect, let me start with external considerations and I'll go to behavioral aspect. What we are saying is that when we are measuring the performance of a business, there are a lot of externalities that can impact on how well the organization has performed or not. Let me help you with another simple way to look at it. There are things that can impact the ability of an organization to meet up with their performance based on external issues. So my question is, what are some of those external issues that we should bear in mind that can impact on how well an organization performs? So when we look at performance measurement in organizations, what are the external considerations that we should be aware of? So who's happy to tell me some of those external considerations, those external factors that can impact the performance of an organization? You know, the whole description of this performance measurement and management conversation we've had here makes it look like, just do what you have to do, achieve your objectives, get this one, get that one. There are a lot of externalities that can be involved in if you can even meet your objective in the first place. So my question is, can you highlight some of those external considerations or external factors? So I want to listen to some of you.
Say government
And let
policies.
me add, and you're correct with government policies, but hold on. I want to do something. The ladies have been extremely very active in the class. So it will be my pleasure to listen to a male person speak, just for gender balancing.
Okay.
You know, when we say gender balancing,
Okay.
yeah.
Government policies.
Yes, that has been said before. Say more.
Issue with conflicts. Conflicts. I mean, if there is no peace, just like what is happening with Ukraine now and then Russia. Natural
Civil
disasters.
unrest, social unrest.
Yeah, civil
Yeah,
unrest.
okay.
Yeah. Natural disasters or epidemic or pandemic, just like the COVID-19.
Okay. Still on that social issues. All right, I agree with you.
Competition.
So you have given me political, you have given me social. Brilliant.
Competition.
Brilliant. Look, if you are in a fiercely competitive sector, it's okay to say, our target is to grow our market share by 60%, by 30%. You have to be alive to the fact that externalities do exist. You cannot be in a competitive sector and begin to set audacious targets like that. In competitive sectors where every competitor is trying to outperform their competitor on the basis of price, on the basis of volume, on the basis of innovation, on the basis of research and development. So I like that. But I still know there are more. I know you can all give me more. So I've gotten 3. I've gotten social issues, civil unrest, political government legislations, government policies. I've heard competition. Can someone tell me more? There are quite a lot more now.
Technological advancement.
Good. Technology is also another one.
Economic recession.
Exactly. Economic factors. Interest rates, exchange rate. I mean, look at what's happening in the country, in Nigeria here. We're in the height of the political season. In fact, the political season will commence from June 1. By Monday, Tuesday, all the parties in Nigeria would have had their political candidates known to the public. Then from Wednesday 1st, we're in a political era. It's important that even as a business, you start rethinking how you look at your performance come the end of the year. Already there are pressures on our FX now. So I agree with you. Economic issues, recession, interest rates, exchange rates, etc. All right. The final part of the syllabus is on digital technology, employability, technology skills, and these are what.
Sorry, Jojo. Can you kindly mention those behavioral aspects?
Oh, I missed it out. You see, don't mind me. I started putting myself under pressure. Sorry, because I want to make sure by 11 we are done with this phase. Okay, so behavioral aspects, and this is very simple. And you who asked me the question, when I explain it, you give me the answer. When you are measuring performance or setting performance targets, because that's part of the process, setting performance targets, there are behavioral considerations that can arise. Those behavioral issues, to be very honest, do arise largely around motivation. And it really comes from how difficult or how easy those performance targets have been. So my point is, you will find that there can be behavioral issues that can arise on the part of the people you are measuring their performance based on how well motivated they are about your performance targets that you've set for them or your performance objectives that have been set. And a simple illustration for this is the relative ease or difficulty associated with those performance targets can be responsible for that. How do you look at behavioral issues when a performance objective or a performance target is quite very difficult? So take for instance a sales manager who has been told that his target is an amount that might be 300% of what the organization did in the prior period. What do you think might be the impact on his motivation or on his behavioral attributes for the period under review? What do you think that might mean for him? I'm asking the gentleman.
Please, can I take the question again?
Okay, who heard the question?
You'll be overwhelmed.
Good. All right. So my point is that, and I think I'll leave it at this, right? My point is that you will find that performance measurement has a behavioral dimension. The point is that when budgets or when performance targets are so difficult or are so easy, so meaning that you must have a balance. That's really the conversation. Your performance objectives, targets, budgets shouldn't be so difficult, shouldn't be so easy. If not, it can impact on the behavioral attitudes of the people who will be measuring their performance. Meaning that set a performance target or performance objectives that should be motivational for the people. It should not be too difficult, it should not be too easy. There must be a balance to it. So when we are looking at external conversations, behavioral issues, sometimes one of the major issues we look at is the motivation on the part of the employees to attain those performance targets. That's really the conversation. So sometimes you might see that an organization has not performed well, and the examiner might ask you, in the light of this poor performance or good performance, what are some of the external and behavioral issues that you can identify? So you might say that the budget seems one that was set at a level that inspired people. Another dimension to even behavioral attitudes related to performance measurement is remuneration. So I've cited motivation, I've cited remuneration, and there's a third one I'm going to add, which is on your appraisal. So let me go with remuneration. You find that many organizations do what they call a performance-based pay. A performance-based pay essentially ensures that people get a remuneration based on how well they have performed vis-a-vis the targets that were set for them. So sometimes you would see a standard pay or what you might call a basic pay. In addition to a basic pay, there's a performance-related pay. So for most of us, if you look at your pay structures, if you work in very structured organization, it will include a standard portion, meaning a standard basic pay, and then there will be a performance-related pay. That improves motivation to wanting to attain your performance targets. One very interesting way in which you can improve behavioral attitudes to budgets or to performance targets is to have a pay structure. It's the same thing you find with some sales marketing staff, where you might be told, look, there's a basic pay, then there are commission you earn on targets you meet. So it's important that you link remuneration as well to setting some of the pay. You will see behavioral issues that you must deal with. And this can help you deal with some of those behavioral issues. Then the final one is obviously around the appraisal. How fair your appraisal measurement system is. Does it reflect what is under the control of the people you are measuring? Do you measure me on what I have control or I don't have control over? Meaning it's your performance measure. Are they fair? Are there things under the control of the people you are reviewing or you are assessing? Is that clear, everyone?
Yes, it is.
I must stop by 11. We'll take a break and then we'll solve the question. I must stop by 11. So section F is employability and technology skills. You look at computer technology to assess information, to access your computer screens, to navigate your windows, etc. So basically, if you use the CBE platform, and I'm going to use that to solve the question we'll do later on, you'll be fine. So I'd like someone to take a snapshot of this, and you can put it on the WhatsApp group if you want to. But just have this. These are key tips I want to share with you. So know your exam. Your exam is a 3 hours exam. You might have some, I think, 10 minutes or so for reading time. You won't all be doing the same set of questions. Different questions will be allocated on different batches. So you have this 10 minutes reading time I spoke about. So it is structured across 3 sections. Section A is made up of 15 objective test questions worth 2 marks. So 15 by 2 will give you 30 marks. Section B is made up of 3 case style questions, and each of those case style questions has 5 objective questions worth 30 marks, because 5 objective questions are 2 marks by 3 case style questions gives you 30. Section C, which is really, for me, the area I want to look at today, will contain 2 constructed response questions, and it can be tested from those CDE areas I told you: decision making, budgeting and control, performance measurement and control. So you will find that you have a choice of spreadsheet or word processor. In fact, it's the examiner that will tell you which you would use. You're going to find it. You know, I wanted us to solve a question on performance measurements, but I did a review. This is the last 6 diets, and this is what I can see around the way questions have been tested. I don't know if you can see something here and why I'm choosing performance measurements. And can somebody tell me something you can notice about performance measurements? Look at it and tell me what you notice.
It comes out consistently.
You say what?
It comes out
I did.
consistently.
Fantastic. Fantastic. So that's why I said to you that, look, you're not going to pass this course if you're not very comfortable on performance measurements. So these are some of the areas I think you should know. You might want to just be sure you're fine.
Sorry, please, can you just go back? Thank you. Thank you. You can proceed. Thank you.
All right, thank you. So these are some of the topics. I'm sure all of you will do well on behavioral issues. Just think of appraisal for behavioral issues. In case it comes up as an objective question, just ace it. Make sure you get your marks here. Think of appraisals. Think of remuneration, performance-based pay. Think of motivation issues. External considerations. Think of political issues. Think of competition. Think of government policies. Think of economic issues, social issues, pandemic, regulatory issues, etc. You can do residual income, you can do this, 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 right? So I think you'll all be fine. This is another one I want you to take note of. You can take a screenshot if you want to. Maximizing your marks, especially for performance measurement, always use headings. It is so important that you use your headings in reflecting your answers. And I'm going to show you one in the question we'll do today. If they say analyze financial and non-financial analysis, carry out a financial and non-financial analysis. For your financial analysis, put it, head it, do it. Put it, head it, do it. This refers to structure. make sure that you can break your questions into smaller sets, right? Meaning like sometimes your question might be useful when you break it as sub questions. A good example is evaluate the financial and non-financial performance of an organization. So it makes sense to say financial performance is one part, non-financial is another part. Very good. Be disciplined on time. Everyone, 1.8 minutes to a mark. Be disciplined on time. If a question is 10 marks, after 18 minutes, stop. Stop. I repeat, stop and move to the next question. All right. Show your calculations. It's always good. The examiner can give you credit for that. Just put it as an appendix. Just put all your calculations, right? Another thing is that at this level, when we are speaking, and we're going to do a question so you appreciate what I mean. When we are looking at performance analysis, don't stop at just calculations. Comment. Don't just tell me, so for example, current assets or current ratio. Current ratio is 2.1. What does that mean? Comment on it. Why is it 2.1? If it has grown from the last period, say current ratio has grown by 20%. I always say, show me the information. Don't show me the data. You know, information means processed data. Process it. Don't be giving me raw info. What else? If you do calculation, yes, it is fine. You get a mark for it. But you will not get full marks by just calculating. What does that mean? Tell me if it has gone up or down. And then the next question is discuss for me. Tracing something you will find in the scenario, why it went up or why it went down. That is where the mark lies in this area. I've seen someone say, I did all my ratios. And I'll tell you that at best, that can give you maybe 6/20. Yes, you did your ratios. Your profit margins, I saw it. But did they grow over the last period? Tell me. If it grew, why did it grow? Are sales all of a sudden increased? Was there an increase in marketing spend that led to more customers? Was there a decline? Was there a shutdown of a particular competitor? Or are the market leader all of a sudden decided to diversify away? Explain to me why that performance is improving or deteriorating. Explain the rationale why there's a change in the performance. And please understand your marking. 1 mark for every calculation. If it is a very simple calculation, it will be 0.5 mark. But please understand it. All right. So we're going to take a break now. Let's take a break for how long? 10 minutes. Is that fine? What's our time?
15.
11:03.
I thought it was 15 minutes.
Okay, let's take a break for 15 minutes and we are back. And then we go straight to the portal and we're going to solve our very first question. Does that work?
Yes.
Yes.
11:20.
All right, so we'll see us in exactly 15 minutes time.
Jojo, please, before you go, can you please mention the behavioral aspect again, the 3 you mentioned?
Okay, so the behavioral aspects stem from the things that can impact people's attitude to meeting performance targets. So I gave you 3 instances where you can largely understand where the behavioral issues are coming from. So one is how fair the appraisal system is or the performance measurement system is. And think about it as, are they under the control? Are you measuring people on things that are under their control? So for example, would you be appraising a sales manager on his ability to ensure that customers purchase several products in the organization, especially if some of those products are products that are not directly linked to your own area of control? I just want to put it in that way. So a good example would be if you're assessing a branch manager on a decision that head office took. So maybe head office has said, look, let's all have a certain machinery across all our branches. And then those machineries cost X amount of dollars. So let's say those machineries cost $1 million. And all of a sudden, the branch manager's profitability is now from a positive amount to a negative amount. The decision to purchase those machineries wasn't his decision. Then you're going to look at his performance and say, your branch has made a loss. Without understanding that part of the reason why they've made a loss is that they incurred significant expense in the period on a decision that wasn't taken by him, but was taken by the head office or from the central executive team. That sort of thing is what I mean. Making sure that your appraisal system is fair. Remuneration is ensuring that when you set performance targets for people, that you can link it to their pay. That you reward people essentially for meeting these targets. That's what I mean. And then motivation is that make sure a budget is not too difficult or a target is not too difficult or not too easy. Is that helpful?
Yes, thank you very much.
All right, so see you guys. I think that should be something like within, depending on where you are, I think that should be 11:20.